Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to a special strategy update. The world economy is probably seeing the biggest crisis in economic terms that it has seen since the financial shock of 2008-9. World GDP could even dip negative in dollar terms this year. You can see the magnitude and scale of the problem from the latest situation report from the WHO, the World Health Organization, showing the spread of the disease globally, but also its move out into the Americas, into Africa, across the emerging world, and of course its intensity in parts of Europe. Also, you can see the characterization today of the disease as officially a pandemic. We've charted the growth in world cases, which you can see rising here to 118,000. Perhaps the first slightly encouraging news is that the numbers in China at 80,000 are at least flattening off. Looked at through 2020, you can see the caseload rolling through the world: China, South Korea, Italy here in yellow, then France, Germany, Spain, United Kingdom, US. We probably expect the UK is somewhere around 2 to 3% behind Italy, but expect some of the containment measures there to be reflected across the rest of the world, just as they were out of Asia into Italy and Europe. The disease is essentially a temporary phenomenon, and we are beginning, as I said, to see some relief in China. Yes, the total cases in China are rolling over, encouraging the remaining cases. Those are those infected and identified as such who have now recovered, is rolling off quite fast, showing that to some extent the disease, once infected, is quite short-lived. Overall, we expect something around 3 to 6 months for the timescale of the intense phase of the programme we're now looking at, although of course there is a risk, as many experts say, of a re-emergence in the winter months of 2020. This is proving so damaging to the US economy, to the world economy, because of the size of the impact the containment measures have. We estimate that almost 25% of hours worked in China were lost in Q1 as supply planes were shut down, people were confined to their homes, and capacity was shuttered. If you compare the GDP impact we estimate of this to first the condition in SARS, China was growing at about 10%. This had a meaningful impact down to 8%. Stimulus and response soon allowed growth to pick up. In this case, we think the numbers are much bigger. This is around about a drop to a 4% or so annualized rate if there is no permanent loss of consumer behavior. But if consumption patterns, investment patterns change, we think the number could take Chinese GDP as low as 2.5%, and that's a huge impact on world growth. We did those numbers almost 3 weeks ago, and they coloured our investment thinking. They encouraged us to take our equities down from overweight to neutral, take out some sensitive materials and cyclically sensitive areas of our portfolio, and to pull risk back generally, even across credit markets. Over the last few days, we run the numbers in the same way for Europe, and we're getting the same outcome: quite a material drawdown. In Italy, the retired chief economist to the Italian Treasury estimates that in areas like tourism and transport, activity is down 90%. In retail operations ex-food, down 50%. Remember that transport, accommodation, tourism and accommodation and restaurants make up somewhere around 20-25% of Greece, Spanish and Italian economies. So the impact is very, very large. We think Italy could contract by 3.9% this year, which would be larger than the contraction we saw in the financial crisis. And similar, although lesser numbers, could be seen in other European economies, taking the Eurozone overall into negative growth for 2020. That is a lot lower number than you're seeing from the IMF, the OECD, and many other forecasters. It comes, of course, particularly for Italy after a lost decade, when after the financial crisis, which saw the US economy grow by almost 20%, the Italian economy was actually smaller. So there are going to be financial stresses that emerge from this. The world economy also was weak before the crisis, unlike 2008-9. China has been consistently slowing into December, and we saw some weak fourth quarter numbers out of Japan, particularly with the consumption tax, and out of Europe. We're also operating with core inflation rates around the world very low. The consumer inflation for at least the higher income countries globally is just 0.7%. That means the risk of deflation is quite material if we see anything like the downturns in pricing that we saw in 08-09. So how will governments and central banks respond? Taking the latter first, to an extent their hands are tied because they used up so much of their firepower when they cut rates aggressively in 2008-09. You can see that in the US at the peak in 2007, rates were 5.5%. Today, before they cut last week, they were just 150 to 175%. In Europe, they were 3.25% before the crisis. They are minus 0.5% today, which is probably why Madame Lagarde was so cautious in her ECB response today, just introducing a new QE package, which is still taking monthly bond purchase only to half their 08 levels, and some targeted lending, but no relief on rate cuts, and this disappointed markets. You can see Mr. Bailey and Mr. Carney's 0.5% cut here in the UK, leaving us only 0.25% before we move to negative territory. The fiscal response is to an extent more encouraging. Direct virus responses around the world total around $130 billion, and the wheels are beginning to turn. But expect some resistance from Germany to aggressive EU budget stimulus, and certainly some politics even on payroll taxes between Trump and the Democrats back in the US. It may be that the UK actually leads the world here with Chancellor Sunak's new budget, plus a 1.3% GDP, strongly stimulative, a £36 billion positive fiscal input into the economy in 21-22, and perhaps that combined with Bailey's rate cut is the model for other countries. One other factor has influenced all of this, which is of course the sharp collapse in oil prices, which was one brought about by the downgraded GDP estimates, but also brought by the battle between the Russians and the Saudis, the second and third largest world oil producers. The race to the bottom that we now see, of course, puts pressure on oil prices. That's good in the long term for the emerging world. But in the short term, it puts huge pressure on oil borrowers, particularly the leveraged shale companies in the US, and adds to stresses and strains in the credit markets that are already vulnerable to a virus-related slowdown. It's part of the reason why we've been consistently strengthening our bond portfolios here at Saracen, which are now average A+ rating with virtually no EM or high yield debt, even in specialist funds. So what does this mean for world markets? Well, we've seen an aggressive fall in world equities and UK equities. When I wrote these charts, they were down 15% and 22% respectively. I'm afraid that's more like 25% and 30% after the falls we've seen today. It's been extraordinarily fast. The peak of markets, peak of the S&P 500, was just the second week of February. It's one of the sharpest declines overall that we've seen. Gold, which we have large positions in, has rallied, and of course government bonds have offset some of that impact. Volatility has soared. The VIX was 53 when I did these charts, up over 60 when I left my desk. That is well above the European sovereign crisis, and not yet at Lehman's levels, but powerfully high. So how are we responding? We've lifted our gilt content, we did that 2 to 3 weeks ago, and added some long-dated government exposure which has rallied well. As I said, we have very underweight exposure to vulnerable corporates and the emerging world. We took our equities to neutral, but in the subsequent downturn allowed our managers to go further underweight. So there's been no buying the dips. We've also seen our portfolio strategies put in place more than a year ago that insure portfolios by buying MSCI World Index puts, cut into support portfolios. To an extent in balance, but very significantly in our target return franchise. And it's nice to see these cut in very well in the crisis. We have a small alternatives book, mainly renewables, but with a large position in gold, which has obviously rallied strongly. Few, I hope, opaque and difficult credit products. We have an overweight position now in cash as markets have fallen. So I hope we will leave you with a stable equity portfolio, thematically driven, meaning that we are well away from the cyclical materials and energy areas. In fact, in most of our portfolios, we have close to zero energy exposure. We think that quality, those long-term themes will come back. The crisis is ultimately temporary, but at the moment we are positioned decisively defensively.